Assalamualaikum and salam sejahtera to Cik Engku Mansur bin Cik Engku Ismail. I am Nurhanisa binti Rasim and my matric number is 275387, and today I would like to present about the cause and effect of inflation from 2010 until 2019. First, I would like to present about the introduction. Inflation occurs when there is a continuous increase in the general level of price. Okay, it reduces a person's income by reducing the purchasing power of money. There are three main criteria to determine inflation. First, increase in general price level. Second is inflation is a continuous in price level, and the third one is the inflation is the unlimited increase in price level. For example, in year 2010, we can get orange juice with only RM 1 ringgit, but in year 2019, we have to pay RM 3 ringgit to get one orange juice. The rising level of price in an economy that does not include the above three criteria does not known as the inflation. So next, what is the cause of inflation? There are four causes. One is demand pull inflation. Second, cost push inflation. Third, imported inflation, and structural inflation. The example of the demand pull inflation is when the quantity demand for some goods or services increasing beyond the capacity of the company of the economy can produce, which is why the price of good is increased. This condition is also known as too much money chasing too few goods. Second is the cost push inflation. For example, cost of producing increasing, such as raw materials, wages, machines, or what else. The firm will transfer the burden of the increasing in cost to the customer by increasing the selling price. The cost of inflation is imported inflation. This is caused by the increase in the price of import goods, which consists of finished goods, intermediate goods, and the raw materials in the production process. Producer will transfer part of the cost to consumers by increasing the selling price if the import goods increase in price. The fourth cause is structural inflation. This occurs because of the government pursue an excessively loose monetary policy. For example, if central bank prints too much money or keeps interest rate too low for too long, the value of each unit of currency drops more than it would. Next, what is the effect of inflation? There is two effect, which is positive and negative effect. So for positive effect, we have this is positive to fixed property owners, shareholder, producer, debtors, and favorable terms of trade. And the negative effect is for pensioner, bondholders, savers, creditors, deficit balance of trade, and devaluation in exchange rate. So we go for positive effect first. The positive effect is, for example, for the positive effect, as we know that there is for the shareholders, producer, debtor, and so on, is positive because they will gain a profit during inflation. Why? Because producer, they can gain the higher profit because the price are higher than the increase of cost of production. They will get the negative effect is because the inflation reduce the individual's income and the value of money. So, for example, for the pensioners or savers, they will gain a loss because of the inflation.
My name is Zhang Yan. My metric number is 265349. Today I will introduce the causes of inflation from year 2010 to 2014 in Malaysia. Malaysia is one of the countries with low inflation rate. The inflation rate has averaged 2.9% per year. In 2010, Malaysia's inflation rate is 1.62%, and in 2011, the inflation rate is 3.2%. In 2012, Malaysia's inflation rate is 1.7%, and the next year the inflation rate is 2.2%, and in 2014, Malaysia's inflation rate is 3.4%. From the table we can note that the increase in inflation in 2011 was mainly due to the increase in restaurants and hotels. The small increase in demand for transport and alcoholic beverages and tobacco led to a small increase in the inflation rate in 2011. Inflation in 2013 was mainly due to the increase in restaurants and hotels, the transport and the food and non-alcoholic beverages. In 2014, inflation was mainly due to the increase of demand for alcoholic beverages and tobacco and the restaurant and hotel. So in my opinion, the main reason for 2010 to 2014 inflation is the increase in alcoholic beverages and tobacco and the restaurant and the hotel, the food and non-alcoholic beverage.
My name is Ho Jia Hui and my metric number is 270413. Now I would like to continue the part for the inflation rate in Malaysia from 2015 to 2019. However, in 2015, Malaysia inflation rate decreased from 3.14% to 2.1% due to a decline in global crude oil price. When the price of crude oil falls, the decline in intermediate petroleum products and costs such as manufacturing and heating will reduce the cost of production, reduce the price of final goods, and eventually reduce the rate of inflation. For 2016, the inflation rate is the same as for 2015 due to an increase in the food and non-alcoholic beverage index and a slight drop in the transport index due to a decline in fuel price. In the year 2017, the inflation rate rose significantly from 2.1% to 3.9%. This is due to a rise in the food and non-alcoholic beverage index and the transport index. According to the Department Statistics, the rise in transport costs is due to the higher fuel price, which accounts for 7.8% of the transport index of fuel and lubricant for personal transport equipment. For 2018, Malaysia experienced an inflation rate below 1% for the first time, which is 0.9%. The main reason for this situation is due to the implementation of zero-rated GST price control scheme and also the discounted price during the festivity. Therefore, the price of goods and services will decline and the inflation rate will fall significantly. In 2019, the inflation rate continued to decrease to 0.7%. This is due to the government has implemented the price ceiling for RON95 and diesel to help the B40 lower income group by reducing their living costs. When the price of RON95 and diesel is limited, households will be able to buy more goods with the same amount of money.
Good morning, sir. My name is Jing Zhengwei, metric number 2Z9451. For the effect of inflation for 2010 to 2019 is encourage spending and investing. Buy now, not later is the planned answer to the decrease in buying power. Cash just lost value, so it's better to stop stopping and stock up of stuff that might not lose value. When inflation occurs, gold and other precious metals are purchased by many investors, but the volatility of this asset can offset the benefit of resisting price increase, especially in the short term. Table 1 shows the inflation rate, consumer spending, and total investment in Malaysia from 2010 to 2019. Graph 1 shows the inflation rate and consumer spending in Malaysia from 2010 to 2019. From graph 1, inflation can encourage consumer spending. When inflation rate increase, consumer spending will increase. This can show in chart above in year 2011, 2012, 2014, and 2017. When inflation rate decrease, consumer spending will decrease. This can show in chart above in year 2015. Graph 2 show the total investment and inflation rate in Malaysia from 2010 to 2019. From graph 2, change in inflation rate can influence change in total investment. When inflation rate increase, total investment will increase. This can show in chart above in year 2011, 2013, and 2014. When inflation rate decrease, total investment will decrease. This can show in chart above in year 2015. The second effect of inflation is reduce the unemployment. There is a proof that the unemployment rate can be lowered by inflation. Rates are so sticky, meaning that with economy change that can slowly change. The surge in unemployment was due to workers being fired because they refused to cut their wage. The same phenomena can function in reverse as well. The upward stickiness of wage means that the actual labor cost of employer can decline once the inflation rate hit a certain amount, and they can recruit more employees. Table 2 shows the inflation rate and employment rate in Malaysia from 2010 to 2019. And graph 3 shows the inflation rate and unemployment rate in Malaysia from 2010 to 2019. From graph 3, change in inflation rate can influence change in employment rate. When inflation rate increase, employment rate will decrease. This can show in chart above in year 2011, 2014, and 2017. When inflation rate decrease, unemployment rate will increase. This can show in chart above in year 2015. Thank you.
Good afternoon, sir. My name is Tam Jin Leon, matrix number 270006. Now I'm going to continue about effects of inflation from 2010 to 2019. The next effect is eroding purchasing power. This is because inflation will reduce time value of money. Simply, purchasing power is how much we can buy using our money, as it depends on the time value of money. While time value of money means how the money available today is more valuable than the same amount of money in the future. Price of goods will rise follow the time because of inflation. If our income does not increase in the future, while prices keep going up due to the inflation, we must use more percentage of our wages to buy the same things. It means our purchasing power has been eroded. And next is increased cost of borrowing. This is the graph of inflation rate and lending interest rate of Malaysia from 2010 to 2019. So, consumers and firms demand to goods and services increase the borrowings to fund for these supplies, and it raises money supply in the market. While supply of goods and services have been limited. Banks lending interest rate undulate followed by money supply in the market and policies of Bank Negara Malaysia (BNM). Large demand of loans cause bank increases its cost, so lending interest rate goes up. When Bank Negara Malaysia raises interest rate to control inflation, it requires banks retain high percentage of cash reserves to fetch up bad loan. Funds will be withdrawn from monetary system to reach this requirement, and it will make the borrowing more difficult to get, and last, increase the cost of borrowing. That's all from me. Thank you.
So next is the conclusion. The methods of control inflation, there are three methods, which is monetary policy, fiscal policy, and direct control policy. The monetary policy, they have two, which is contractionary quantitative and contractionary qualitative policies. The government applies contractionary quantitative and the qualitative monetary policy, which will decrease the money supply and credit creation, and hence decrease the aggregate demand in order to stabilize the economic situation and to control the economic inflation. So for the contractionary quantitative, they have a rising stationary reserve requirement, rising minimum requirement of liquidated assets, sell government securities in the open market operation, increase bank rate or discount rate, raise interest rate, and the funding. So I will explain to you the sale government securities in the open market operation. During inflation, the money supply must be reduced. As such, the central bank will sell short-term bonds or treasury bills to commercial banks or to public. This results in the transfer of a part of bank deposits to the central bank account and reduce the cash reserve and the credit creation capacity of commercial banks. Checks are also made payable to the central bank. The result are a decrease in the consumer expenditure. So, for the qualitative monetary policy, is to discourage banks from borrowing. The quantitative policy aims at controlling and discourage activities in specific economic sector. In example, central bank will instruct commercial bank to reduce the volume of loans given to the public and influence commercial banks to restrict their lending policies, such as the need for collateral security, guarantors, and the other measures that will discourage borrowings. So next, the fiscal policy. Fiscal policy is also known as a surplus budget. The government can implement a contracting fiscal policy during inflation by increasing taxes or reducing government expenditure, or both. When taxes are increased and the government expenditure is reduced, aggregate demand will drop and prevent the increase in the price of goods and services. There are three in fiscal policy. One is decrease government expenditure, lower transfer payment, and increase tax. The people's disposable income and their consumption will fall. A highly regressive tax structure can successfully reduce the impact of inflation in the company. Lastly, the direct control policy. For direct control policy, it contains so many tools that government can do. For example, price control, rationing, reduce import tax, and intermediate goods. So I will explain to you the price control. Where price of certain goods can control, whereby the government can implement a ceiling price policy, which sets the maximum price of certain goods. This will prevent the seller or producers from selling at a higher price as their wishes. The government will control the ceiling price and the floor price. So that's all from Group 7. Thank you, sir, for your time.